Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they are going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
And welcome back to Contrasting Viewpoints. I'm Ray Sclafani here with the ever-opinionated Mark Hurley.
Obviously confusing, opinionated with sweet and sensitive, but it's great to be here too.
All right, everybody, buckle up. Today, we're slicing through the week's biggest wealth management headlines before diving into our main topic, what AI really means for advisory firms. We've got Parker Ence, CEO of Jump, waiting in the green room with a fresh take on using AI to turbocharge client acquisition and portfolio efficiency. But first, the news. We've got a number of interesting stories we'll share with everybody. And yes, our favorite segment, You've Got to Be Kidding Me, where skinny jean millennials try to squeeze the once sacred 1% fee. So we're going to get into that. That'll be an interesting topic. Okay, first, let's hit a couple of stories here. FA Magazine, Jerry Prince and Russ Allen Prince had a headline, Generative AI will not replace emotionally intelligent advisors, at least not by 2034, where there are expected to be far fewer advisors. They say the rapid advancements in generative AI may prompt some wealth management clients to forsake human advisors, but it's important to note that an increasing number of stories are emerging about people forming real relationships with chatbots. Okay, I've got a few thoughts about this. Why don't you go first?
Oh, okay. Look, I'm always been a kind of skeptical of this. I believe what a wealth manager does at their core is help people manage the most complicated relationship in their lives, which is the relationship they have with their money. And nothing's going to change that. I think AI can be very helpful and incremental. Now, this article is typical of the headline is different than the substance, as is typical. It says in 2034, there'll be far, far fewer advisors. Not really. In fact, if anything, the number of clients coming into the industry, if you look at the population, should more than double, because there's 7 million more Americans between the ages of 45 and 60 than are 60 to 75. So, but if you actually dig down, what they're really saying is that some of the technical specialties that you may have in your firm, where some person handles this area and that's their primary function, that may be replaced by generative AI. And I think that's reasonable. But I think if anything, as AI plays a larger role in our lives, the human element has become more and more important as opposed to less important.
So I don't disagree with this notion, and I followed Russ Allen Prince my entire career, and he's an absolutely genius when it comes to understanding clients and communicating with clients and the power of emotional intelligence. But there is an emerging thought that there's a Hugh Tech approach, and AI chatbots, a generative AI, are going to play a larger role helping advisors connect with clients. I mean, imagine a world in the future, 5 to 7 years from now, where an advisor actually says to a client, hey, why don't you talk to me, talk to my sidekick advisor, and they'll collect some fact-finding information, analyze investment reports, all your 401k information, and then we'll get back together and talk about a plan that our agent AI over here, Sidekick, has actually created. I don't think that's too far off, believe it or not.
But look, though, the other issue that no one's talking about is to make AI work really well, you need a staggering amount of data. And there are only two groups in the world that have data when it comes to this area. They're called Schwab and Fidelity. It's not clear to me they're going to start making those widely available to software developers. Secondly, if you look at the cost of developing OpenAI, which I mean, you could fund a small country, what they've spent there, and just to maintain it every year is like $6 or $7 billion. It's not clear to me how you develop these tools and make any money doing it. And fundamentally, people are going to do that. That's what they're going to be focused on.
Well, Character AI did it. I mean, there's an emerging story out of Orlando, Florida, that's alarming. And most people say, oh, we'll never deal with robots. We won't talk to robots and build relationship with robot. Yet there was an emotional attachment by Sewell Seltzer, a 14-year-old boy out of Florida, who developed a deep emotional connection with an AI chatbot. modeled after, I won't say it right, Daenerys Targaryen from Game of Thrones.
Yeah.
So the character AI platform had this online interaction, and 14, 15, 16-year-old boys are developing these relationships. And a tragic outcome, February 28th of 2024, Setzer died by suicide.
Look,
And
you're in my wheelhouse now. This is the cyber area, and this is what we worry about all the time because people are not protecting their social media accounts, and therefore it's easy to figure out how to profile and target them. And it's not just kids. We're seeing elderly. They're targeting this way. But I guess my point wasn't so much that they won't be able to develop bots that can manipulate human emotions. They already exist. My concern is in terms of doing what wealth managers do, which is very complex levels of financial advice. You need to have large sets of data for the AI to be effective, and the problem is the people who control the data aren't giving it up.
That's a fair point. I have heard from a number of large RIAs. I just came back from Chip Room's Tiburon Strategic Advisor Conference, and there were a fair amount of fintech CEOs and a lot of investment being made at the present moment right into these AI space, and specifically in building AI generative agents that can actually interact with clients. There will be a world I can see in the future that we will interact with some kind of a generative AI advisor, not for the emotionally intelligent piece. And I think that's where Russ Allen Prince makes a really important point, that there are things that the human can do that the robot won't do, and we're not going to replace all advisors with some AI agent.
Yeah, and the other thing is the last 10 feet. This is the thing no one ever likes to talk about. My nephew's
What do you mean by the last 10 feet?
AI guy. He says, everyone talks about you develop these things and they're so effective, but 90% of the way there is easy to get there. It's the last 10%. And when you get to interfacing with human beings, the question is how do you make it so that people can learn how to use these things, get comfortable with them, and adopt them? In the case of this 14-year-old boy, you had somebody who was out on the web looking for emotional connection, and cyber criminals used some bots to target the kid. And they've done this with the elderly too. People are isolated and alone. It's fundamentally different when you're going to start trying to connect with people with their money, try to get into, and their own technology has to work in a certain way. They're not just simply going to say, "Okay, I'll come contact me and I'll deal with you." I think there's a lot more steps than people are giving credit for to actually make all this work.
Well, this is an interesting article. I'd encourage everybody to read it. We've all received that email from purportedly our child or significant other that says, "Hey, I'm in Paris and I'm stuck, and please wire me $20,000." Right? I mean, I think that's gone around the world 10 times.
No, I just get ones from Nigerian princesses, but yes.
Yeah, you've inherited $1 billion. Contact me now. Well, there's somebody who may not be educated enough that clicks on the link, right, gets a phone call, and now they're draining their bank account. That stuff is real. It was interesting for me. I was recently in an airport, and I had a kind of an odd experience. I walked into sort of a kiosk area to buy food. I was picking up, Power Bar and a bottle of water before jumping on the plane, and there was nobody there. It was just there were people shopping, but there was no agent. There was just a kiosk. And so I picked up my stuff and I went over to the machine. I scanned and then I tapped my iPhone and paid. Didn't pull out a wallet. Asked me if I needed a receipt. And my natural reaction is, no, I don't want to carry a bunch of paper. So I hit no receipt. And then I grabbed my stuff and I realized, oh my gosh, I feel like a thief. I mean, I really paid for it. I'm looking around. There's cameras everywhere. And I held up exactly what I bought and I walked out, showing that I had paid for everything. Okay, now why am I sharing that story? Because I can remember a time when I was sitting at a Raymond James conference on a Friday afternoon, speaking to a group of 300 advisors, and I asked everybody, who here, raise a hand if you've bought something online. 2 hands went up. And Amazon hadn't really made its splash just yet. And I had just finished registering for the Philadelphia Marathon, which I ran, but I got hacked. And it was the first purchase I ever made online was through an online registration for the Philadelphia Marathon. And immediately I got notification that 9 Dell computers were being delivered to an apartment in Philadelphia. Okay. So, I share these two funny stories because they're connected, and they're connected to what Russ Allen's Prince is talking about in this conversation, which is, there was once a time we weren't comfortable buying things online.
Oh, yeah.
And now it's the norm. I mean, I think something shows up at our house every day from Amazon. Shopping, groceries. I mean, you name it. Everything's getting delivered to the house. We're buying everything online. And while I'm not used to today yet buying something without an agent at the store, in the airport, that's going to become a norm. And sooner than later, we're going to be talking to lots of agents. We don't even know our agents online. And it won't be long before advisors start being really smart about building their own large language model advisor robot that can do a lot of the work that advisors can do. And then I'm an advocate for the advisor. The emotional intelligent quotient, that leaning in and building trust, I think this becomes a trust issue between advisor and client. And we're not going to replace that in our
I think it's always
future.
been. All you're saying is they're going to strip away the stuff that doesn't matter.
Yeah.
And I agree with that strongly.
Yeah. Okay. That's a first time we've agreed on something like that in a while. So that's pretty good. We want to go to the next story?
Yeah.
Okay. So CFP board hikes the annual fee by $120 to fund an ad campaign. This comes out of CityWire. The price hike, which ups the annual fee from the previous mark of $455, is going to take effect October 1st for both renewals and new certificates. The decision comes as the CFP board attempts to bolster its marketing presence through an expanded public awareness campaign. The company said in a release that $280 of the $575 fee, that's a pretty big piece, will go directly toward, quote, expenses of the campaign and comprise about a quarter of the $12.5 million needed for a fall 2025 broadcast advertising window. The remaining three quarters needed will come from CFP board's investment reserve. This is an interesting move by the CFP board. And we're seeing more and more ads every day. It sounds like we're going to see a lot more in the fall about the CFP certification and where things are headed.
Yeah, I guess I wonder a little bit. Well, clearly, we're going to find out how much price elasticity there is to being a CFP. Because when you raise the price of retaining your membership or your certification by 25%, you'll see how many people are willing to pay that difference. But on top of that, you're talking about trying to create within the general populace, it sounds like, an awareness of CFP, and you're spending how much? That's just not going to move the needle.
It's a fraction. I mean, Schwab spends what, $585 million a year on marketing by comparison?
A year.
Yeah. It's
this is like whizzing in the ocean. I mean, it's not going to really move the needle. It also suggests that there's a time when having a CFP was such a distinguishing feature that, oh my goodness, you could say, well, he's a CFP. And I can remember when a CFA was the same way a long time ago. Well, for now, I think what you're going to see is that they're trying to find a way to remain relevant. And the way they hope to remain relevant is to have the consumer say, hey, I want to talk to you about, do you have a CFP or not?
Right. And a shout out to the Investment and Wealth Institute, who has introduced what I call at least advisors tell me they call it, the CFP on steroids, which is the Chartered Private Wealth Advisor designation, which is emerging as a pretty sophisticated level of talent and experience for those committed to serving more affluent clients. So it'll be interesting to see if CFP, what happens with membership. And we can look up and see roughly 104,000 members today. Maybe we mark that with a chalk line on the wall and see what it looks like a year from now.
Well, they're worried too because so many people are retiring. They're going to have to replace those people to maintain their revenues.
Okay, let's move on to an article, Francesca McClin out of FA Magazine, Escape the Sea of Sameness. I love that quote. Create your unfair advantage. While only 10.6% of advisors admit differentiation is their biggest challenge, and you know something about this, having written that Welcome to the Jungle white paper, the real story is much deeper. The top challenges, landing new business and converting prospective clients, are symptoms of the same disease, failing to stand out in a crowded marketplace. What's the cost? When prospects can't immediately grasp what makes you special, they either walk away or get stuck in the dreaded "I'll think about it" limbo for months. I think this falls into the category of, hey, let's focus everywhere. All rich people are the target market, and there's no differentiation in a sea of sameness. So good article. I think a real awareness to what the issue is. and what it's going to look like in the future if you want to compete in organic growth. We may be totally in agreement on this one.
Yeah, I have several friends who are longtime veterans of the industry, and one of them told me that one of the more unnerving changes they've seen was they can remember 20 years ago that they got somebody into the office, they had between a 90 to 95% conversion rate into a client, and now it's under 50%. Now, part of that is there's more people besieging them trying to offer advice, et cetera. But the industry has never really had to distinguish as individual firms what they do different from anyone else because there have been too many clients out there relative to the supply of advisors. Those lines are starting to get closer together, particularly as you see these mega firms expanding their capability and converting it where the advisor is bringing the client in to where the firm is bringing the client in. Now, for now, you still have this tidal wave of new clients coming in, so I don't think people are seeing this change occurring. But what happens is when it does occur, we actually have to distinguish what you're doing. Then it's very sudden, and if you haven't done it, it's very ugly. It's very hard to play catch-up on this. We're seeing people, for example, in the cyberspace, or 4 large firms we're working with who are going to increasingly develop campaign or are developing campaigns which say, if your advisor is not talking to you about the biggest risk to your wealth, which is that someone steals it, as opposed to the markets go up or down, then you probably need another advisor. That's a differentiating feature. We've seen people doing it in specialties involving certain professions. But again, there's never been urgency to do this because there's been just so many clients sitting out there, prospects sitting out there. At some point, those two lines cross.
The
and
game's
if you aren't
changed.
differentiating, good luck.
Yeah,
It's going to get exciting and not in a good way.
Yeah, that's right. So, okay, let's go on to the next story from Investment News. Andrew Cohen, iCapital, and CAS have partnered up to help advisors tap into what he calls the golden era of sports team investing. A couple of interesting statistics here. The global sports industry revenue in 2024 peaked at a record $170 billion. That marks a 7% increase from the previous year. The NFL, by the way, led with $14 billion in earnings, and 19 of the top 20 sports properties experienced revenue growth during that period. The appreciation of NFL franchises between 2002 and 2022, that's a 20-year span, NFL franchises saw a 600% increase in value. You look at returns on sports franchise investments, they've yielded an average annual return of about 13% over the past 60 years. And we're seeing growth in the sports analytics market and expansion in online betting. In 2024 alone, the U.S. online sports betting market generated over $14 billion in revenue, reflecting a nearly 30% increase from the previous year. The quote from Matt Lindemholm from a partner at CAS says, "We think everything in sports world from an investment standpoint is attractive to what an investor would want." This comes as many advisors are looking to help their clients get into this space. This is a big deal article. I think this is one of those differentiation pieces, but this is all kind of an interesting approach, looking at alternative investments rather than just the traditional. It's a big opportunity here for advisors for sure.
Yeah, I met a guy who a while back whose job was to help sell sports franchises. And I asked him, how do you actually value these things? And he says, it's a tiny little bit of cash flow and a whole lot of ego. Now, the question I would ask is, by starting this and giving the opportunity, the fact that all these various leagues are letting individual investors come in through these vehicles, does that mean we're at the top? In other words, how much more can these things keep going up? You just had the Washington Redskins trade for $5.5 billion. Is this thing in 10 years going to be worth $30 billion? I don't know. I mean, again, so much of our society has gotten focused on watching the TVs and streaming, et cetera, and less interaction with each other. Is this going to make these types of franchises even more valuable? I'm not sure. But it just strikes me as a bit unusual because usually most of the wealth managers I've known over the last 30 years in this industry are always focusing for things that are out of favor, as opposed to these things are at the absolute top tick right now in terms of favor. And the only question is, can it continue to rise at this kind of rate?
Yeah, this is maybe where, again, I disagree with you. I don't know that they're top ticking here. I think this is just the beginning of what's going to be a bigger expansion. I mean, you look at F1 sports. You're looking at, nowadays where you can get everything online, on demand. Frankly, in today's world, who wants to watch a replay of the Yankees, beat up on the Padres? I mean, we went 10 innings last night, and I was, sitting on MLB.com watching live. If I had known the Yankees were going to win, like I just spoil alert for everybody. If you know who's going to want to go back and watch that game? Nobody. So this is a beginning, I think, of an investing area that's only going to explode, I think, for those that are paying attention.
Yeah, the question isn't whether these things will retain value. The question is how much they'll appreciate. Plus, you don't get cash flow from them. The NFL franchises throw off cash flow. Most of the other ones don't. And so
that's fair. That's fair.
It's described as like owning a winery. You put money into it every year, and then when you sell it, you make lots of money.
Right.
And in the interim, you're the guy who owns that famous wine.
Yeah, it's worse than a boat.
That's right.
I'm going to pull out a 20-year-old quote. There's a gentleman by the name of Sal Galeotto. I'll never say his
Galeotto.
name. Galeotto, yeah. Sal, he's over at Emigrant, and he's been investing in this space for a really long time. In fact, he's got amazing stories about George Steinbrenner and was built his whole career around selling fractional shares of the Yankees. I'm a Yankee fan, so I'm always very interested. But 20 years ago, he had a quote. He said, "People become very wealthy in other businesses. Then oftentimes, for the love of the game, they come into one of the professional sports leagues, and many of them really wind up enjoying it." In other words, this may be a great investment, but it's also an area where affluent are looking to enjoy the spending of their money.
Yeah, so it's this whole FanDuel's theory. FanDuel, my nephew works for FanDuel. It's by getting you feeling like you're involved in the event, you have more interest in the event because you have some money in the event. It's brilliant.
Yeah, brilliant. Look at ESPN. I mean, that March Madness thing, fantasy football. I'm not really a Cleveland Browns fan, but man, am I going to tune in because I'm looking at that running back or Shedeur. Now I'm going to watch Shedeur. Is he playing? Can I play him this week? Is he going to be in the game? Like the NFL is genius. The March Madness is and it's all fantasy. And so listen, Mark, I think this investing thing is just at the beginning stages.
Hey, the Ocho, remember that?
The Ocho, yeah, that's right. Okay, so let's go to one of our favorite segments before the main topic, and we're joined by Parker Ence, the CEO of Jump. But you've got to be kidding me. The unbreakable 1% fee looks vulnerable to new threats from young clients in skinny jeans, says Cerulli. But falling fees are not a fait accompli. Analysts counter by 2036, 83% of advisors expect to charge less than 1% for clients with more than $5 million in investable assets. Yeah, frankly, I think many are charging 54 to 72 basis points.
I don't know anyone is already.
Yeah, right. Okay, so like this is the dumbest thing ever. The average fee for clients with more than 10 million in assets is expected to be around 66 basis points, representing a slight decrease from current costs. This is nearly half the anticipated cost for clients with 100,000 in investable assets. Advisors haven't been able to charge 1% for clients over 5 million for a really long time. I don't know what they're thinking. They're smoking
this is one of those flashing alert headlines. 15 on a scale of 1 to 10. In reality, someone's going, what planet do you people live on?
Yeah, I mean,
is there oxygen there?
Yeah, they may be using robots to write articles over there at RA Biz. This one, this one's nuts.
It's RA Biz. They check.
RA Biz.
Check and recheck.
I do recall being in the downtown office on Ackerd Street of Smith Barney back 100 years ago. And I remember the branch manager in the conference room saying to advisors in an aftermarket session how important fee-based business was going to be in the future, and you could charge 2.5% on assets, and $100 million in assets, which back 100 years ago was like a gazillion dollars. Nobody had $100 million in assets. That was a high watermark, and I thought, wow, man, 2.5%. And he said, you'll never have to worry about turning the lights on. You can actually work 1 or 2 days a week, and all trees grow to the sky. And it was. And I've watched over the years these businesses that have grown substantially, and that fee on AUM has really settled in at a norm. But advisors, I think, aside from the ridiculousness of this article, I think the importance here to draw attention to is advisors have to figure out how to do more for clients with a more realistic fee on AUM. And that fee on AUM doesn't really represent the true value the advisor brings to the relationship.
Yeah, and if you want an example of what's coming, go look at the multifamily offices.
100%.
Look at all the M&A in the multifamily offices in the last year or so have been not about buying other firms to get the clients necessarily, but rather in terms of buying firms that have funds. Because the fees they get on the advisor side are so trivial relative to the work they have to do that the only way they can really make money is they give extra alternatives for their clients to invest money into in pooled vehicles, and that they can capture extra revenue. So in other words, they've had to find an additional revenue source or they effectively can't make money. I remember back when I sold my first business to JP Morgan, 20 plus years ago, the private bank at JP Morgan had like 10 times more assets which was dealing the ultra high net worth than the people they just bought from Bank One. And Bank One guys were making like 10 times as much money as the people in the private bank. This is the dichotomy. As you get larger as a client, what you're willing to pay goes down, but your services demands continue to rise. And that trend will continue down from the ultra high net worth to the high net worth. And then, it's a gradual progression. It's just market efficiency.
More and more advisors are going to look like mini family offices. And I would say if you haven't checked out the Institute for High Net Worth, go online and check it out because there's some really good tools and research about how advisors will be serving clients in the future. And so anyway, that article, while ridiculous, I think points to maybe let's think about this in a little bit different way. So hopefully listeners are getting some value, even chuckling at the article, but really thinking about their own businesses and the future of how they serve clients. Okay,
Definitely.
Main topic, wealth management and AI with Parker Ence. For those of you that don't know Parker, who's the CEO and co-founder of Jump, he has an unconventional background that enriches his leadership in the fintech space. Before his ventures into technology and finance, many may not know Parker was a guitar teacher, a role that honed his skills in communication, patience, and adaptability. These qualities have translated well into his current endeavors. He focuses on leveraging AI to streamline administrative tasks for financial advisors, allowing them to concentrate more on client relationships. He's a graduate of the University of Utah and Stanford Business School. We invited him because he has a very strong view, maybe not as strong as Mark's, but one that is pretty strong on how AI is going to impact the wealth management industry. Mark and I have like 100 questions for him. I will tell you that Parker also has a really good sense of humor. He posts on LinkedIn, Jump is proud to announce the acquisition of Commonwealth Financial Network, $285 billion AUM RIA for $2.5 billion in cash. I mean, he's always playing a good game with everybody. So, hey, Parker, welcome to the show, and thanks for being here with Mark and me.
Hey, thank you so much for having me, Ray and Mark. That was my April Fool's joke that you just referenced, and I had a few people that didn't read far enough down, and they were texting me like, "What is this?" and "What's going on?" So
that was good.
Yeah, thank you so much for having me.
You got it. Well, hey, tell us a little bit about Jump from your words. We know what Jump is all about, but it's making waves in the industry, and advisors are looking for great technology, and they're wondering where to go with AI, and Jump is a great beginning place. So tell us a little bit about Jump and how it helps advisors streamline workflows and improve their efficiency.
Yeah, yeah, absolutely. So we've been in market for a few years now. So Jump is one of the highest adopted AI technologies within financial advisory. And I think the reason for that is if I'm a firm leader, I know that I need to start pulling in some AI capabilities. And I'm not probably quite yet to let the robots do all the portfolio construction and trades for me. That seems a little bit soon, a little bit risky. And I'm also concerned about compliance and all kinds of other things around safety. And so a really good place to start is efficiency. So what Jump essentially does is help advisors save a ton of time. If you look at the Kitsis research on how advisors spend their time, you'll see that an average advisor is going to spend about a third of their time on pre and post meeting administrative work, whether that's kind of digging through your old notes to figure out, what should I be prepared with as I get ready for this meeting, or after the meeting, I've got to write up my compliance note. I've got to update my CRM. I've got to send an email back to the client summarizing what we're doing. I've got to pull out all the things I learned and incorporate those into the financial plan or into investment management. To do all of that service and preparation and post-meeting follow-up, it could be an hour of work for every hour that you're in with the client, depending on how dense that meeting was. And so we use generative AI to try to AI away a lot of that administrative work. And I think the reason that we've been adopted so quickly, in the words of our very first customer, who was a breakaway RIA owner, he told me, look, I love working with clients. I love investments. I do not love typing things into my CRM. If you can AI away some of this administrative work, I'm going to get back a bunch of hours of my day. I'm going to be able to follow up faster with my clients. I'm going to remember more important details that I would otherwise forget. So that's what we've been working on at Jump, and we're currently serving about 9,000 advisors, so it's been really fun to see that growth.
Yeah, you've got captured like 5% of the industry according to the T3 survey that was just published, but that may be even lagging where it's going. An advisor I was talking to told me the reason they like using it is because it's the first tool of this type that actually I don't know if the word is understands, but can incorporate financial terms as opposed to having to translate what that means over, because some of the other platforms out there don't understand some of this communication, what's actually being said in the meetings.
Yeah, I think that's right. So if you think about, and this is probably the case with any technology decision, if you recognize, hey, I've got some kind of problem or project, I want to look to technology to solve it. What are my options? Well, I can always try to build it myself. And for most, that's usually a bad idea unless maybe you're JP Morgan or like you've got like, hundreds or thousands of software engineers at your
and a lot of money.
Call. And even then, maybe not. So that's one option. Or you can go to kind of the generic tools, right? Like you could use Microsoft Excel to do financial planning or to do all kinds of things, but it's not really specific. And so I think the reason that Jump's focused on advisor-specific workflows, advisor-specific content, advisor-specific integrations with the rest of the tech stack, compliance considerations around how do we actually capture this data safely, how do we process it safely, how do we store or not store it, and having a bunch of different options for the CCO. So I think that's been really important. And actually, Kitsis actually did a big write-up about our category, and one of the things that jumped right out to me was that advisor-specific offerings in this category have a much higher satisfaction rating than things like, for example, Zoom AI Companion, which is a good tool for sort of general business use, but maybe not the best for processing financial, like the specifics of financial planning, et cetera.
Yeah, I mean, you point to a key issue, which is increasingly AI is going to have to be even more specialized to the specific function. In other words, most of the two AI tools that are coming out are useful, but they're generic. And what your product, for at least the wealth management industry, in my view, is one of the first ones that does effectively allows people in the specific function that they're doing to take advantage of it, as opposed to, well, you can collect a lot of information and organize and sort of your notes, but it doesn't really actually go kind of the next step, so that there's not as much follow-on work when the AI is done to correct it, for lack of a better term.
Yeah, I think that's right. So chapter 1 of Jump has been all about how do we save a lot of time, so that the average Jump user is going to come back and say, hey, I've saved at least an hour a day, just because I'm not having to manually type out all of these different follow-ups and my notes. So that's been chapter 1. That's been great. What we're looking towards now is one of the most exciting concepts in this current wave of generative AI is this thing. It's got kind of a flashy name, but it's agentic workflows or agents. And it's just a fancy way of saying, can we get these AI systems to actually do work for us? And so we're starting to look at how do we create a bunch of easy buttons on all of that admin work that you have to do after the meeting, whether it's opening an account or sending out a document or scheduling the next meeting. There are all these little things that AI is now capable of doing, which is really exciting. So we're excited about that. And then the other piece is there's all this data that is contained, rich data that's contained in a conversation between the advisor and the client. That could be an hour of pretty interesting data. And so imagine having that data across tens of thousands, hundreds of thousands, millions of conversations. What could we learn as an industry from those conversations about what investors care about, how that's changing over time, what advisors are trying, and is it working or not working? And so we're excited about things like scorecards and kind of data mining, a lot of that. Of course,
but is there enough data? That's my question. I mean, you have to have an enormously installed user base. And we've done a phenomenal job. Not criticizing that. And this gets to AI in general in the industry. It's one of the first questions that I've raised with Ray when we debate this all the time is, there's only two organizations that have all the data right now. It's called Schwab and Fidelity. They have the large enough sets. You're going across relatively small businesses, and from that trying to create models, learning models based on relatively small amounts of data. Because most firms, even if you have 9,000 firms, they're going to bring in a year. Let's assume maybe 30,000 clients of that many, maybe 20,000 clients. Okay, and from that you generate data. The question is how do you actually build the next stage of these models when there isn't that great data set that's out there?
Yeah, it's a good question. So I think what I was referring to a minute ago was less about training models. So I think in the early innings of generative AI, it was really exciting to believe that you could sort of train your own model and that would give you some kind of an advantage. I think what's actually happened is you have what's called these large language models that are trained by companies that have billions of dollars and access to incredibly large amounts of data. And it turns out that those large language models, in almost all cases, are outperforming these smaller special purpose models. And so, just as an example, at Jump, we're not really looking to train our own large language model. We're not trying to create our own ChatGPT, in other words. We're trying to apply that in the same way that we're not trying to reinvent the internet, right? Like the internet is like this utility that we all can use to build awesome applications on top of that. Same as cloud computing. I think that is really the key, is how do we apply these large language models? And so when I say there's all this data, what I mean is, can you take a sample size of 1,000 meetings and can you scrub out all of the personally identifiable information so that's a safe data set to use? And then can you look at things like when these tariffs are announced, what does that do to the conversation? What issues does that raise for clients? How are advisors handling it? What's the impact on where resources are flowing? And so as an example, we looked at that and we found that if tariffs were discussed in these meetings, it was almost 3 times more likely that the client ended up moving things into cash as compared to meetings where tariffs were not discussed. That's just one very simple example.
Is N of 1,000 large enough to really reflect what's going on?
Yeah, and of course we have data scientists that can make sure we're statistically significant in these things, and so just that was sort of one example that wasn't meant to be definitive.
Okay, so Parker,
definitive.
Yeah. So let me ask, what's the biggest ethical line that advisors and firms should think about not crossing when it comes to using AI in client engagement or advice delivery? This sounds like Big Brother's listening. What are those ethical?
Yeah, what's the privacy protections, for example?
Yeah, great question. I think this is something that we've seen a lot over the last 18 months as we've worked with, we're now working with most of the leading broker-dealers at this point, LPL, Cetera, Osaic, Raymond James. We're also working with a lot of the major national RIAs and, of course, many small firms as well. And because the SEC and FINRA, they haven't come out and given kind of 1A, 1B, 1C guidance on exactly how to handle these things.
That's going to be my next question.
Yeah. So what can we do? Well, we're sort of left to look at the existing rules around cybersecurity, data privacy, and apply them the best we can to the new capabilities and even
we're
risks.
Still waiting, even Mark, right, for the cyber for the SEC to come out on cyber.
Yeah, in our experience in our business is customers are far more worried about privacy, believe it or not, even than cybersecurity.
100%. My Alexa is listening to me all the time. I've turned her off.
Yep.
I don't want it.
For example, we help set up home networks to make them secure for families. They don't want us to leave anything behind so we can see what's going on. In fact, that's a non-starter. So I guess a lot of this gets to the economic model. For example, your company, is your model entirely based off the fees that people are paying you, or do you have other sources of revenue that are being generated through your technology?
Yeah, so we just our company makes money it's just like any software company. So we charge a software fee to the advisors that purchase the software. There's no other.
Well, no, there's a little software company called Google that makes money other ways. Okay.
Yeah.
They've done well.
Yeah, that's right. We're not like Google.
No. I'm saying is, but this is the concern I think you'll have.
Yeah,
as
people are going to package that, right?
You gave a phenomenal speech in Nashville that, we met, and I wanted you to come join us today. But the question that's always kind of Ray and I have knocked back and forth is, okay, how much can you bring AI into a wealth management business and still make sure clients feel that their privacy is being protected, that we're not having an Orwellian experience as you automate more of the business. And then the question is how do you ensure the vendors are not capitalizing on this? Because, for example, we're doing not AI, we're doing some much lower tech. We're helping set up people on their personal cybersecurity. One of the reasons why we passed on one of the password managers is when you actually diligence through the password manager, you found out they were collecting and selling their clients' information. And that makes it a non-starter. And so my question is, how should they think about that? And then what limitations does that make? Because it costs so much to make AI software. And how do you get an adequate return on it?
Yeah, it's a great question. So maybe a couple of things. I think there are probably two categories of concern that sometimes come up. The first is the reality of just logistically, how do we actually protect this data, right? And so, if you kind of look at the cycle of how this data flows into software like Jump, there's some kind of capture mechanism. It's usually the audio of a meeting, whether it's a virtual meeting or an in-person meeting or a phone call, has to flow into our software. And we take that and then we process that audio and we generate various summaries. So the first thing is there are actually a bunch of federal and state laws around capturing conversations electronically. And so we make it very easy for our customers to make sure they're doing proper disclosure and that they have the opportunity to capture consent. So that's sort of number one, just very basic. The second piece is we're dealing with conversations that are being captured electronically. So what does that mean from a books and records perspective? And we've actually seen firms take different approaches to this. Some are treating these conversations like an email that needs to be archived forever. Others are treating it in other ways. And so we don't really take a hard position on what the right way to do there is. We just provide a bunch of different configuration options and let the chief compliance officer and the risk team and the legal team decide what they want to do. And then they can build that configuration into Jump. And then there's also just data handling, right? So Jump's never going to share that data with anybody. We're not going to sell it. The data that comes in and also the AI summaries that are generated based on that data are all owned by the advisor or their firm. And of course, we go through all the normal things that you'd expect from any modern software company, SOC 2 Type 2. We also use the HIPAA protocol because this conversation data might include healthcare information. So we do all of those things. And I think it's actually really important. And you do need to read through the fine print about how the data is used, who owns it. Or one thing that the SEC has actually said is, look, if you're using a large language model, something like ChatGPT, you need to make sure that the data that you're putting into that model is not used to train that model, because there's risk that if the model learns your data, there's a risk it could leak out to some other user somewhere else. And so we don't, as an example, we do not train any models, right? So there's that's like super important.
Yeah, so you're suggesting diligence on part of the advisor, particularly with regards to disclosure, should be incredibly robust. Because you talked about your speech in Nashville, which I thought was superb. Your argument is if an advisor isn't incorporating AI into their business, they're going to have a ferociously less efficient model. Ergo, they will be at a competitive disadvantage. Now, granted, there's an inertia to clients that is so scary that I don't know if things are going to go out of business if they don't do this, but they'll be making much less money, and as market forces squeeze margins, they'll have a less valuable enterprise if they don't adopt this stuff. But what do you see next? All right, you've taken on the first thing here. You've done a phenomenally successful thing, and I might add, as a Stanford graduate school of business alum, very proud of what you've done. But what's the next evolution?
Yeah,
for
go
AI
3 to 5 years out. What does
Yeah.
AI reshape sort of that competitive edge into the future?
Yeah, so I think there are probably two main things. Let's say three main things. So the first is, even if an advisor does not proactively go out looking for AI tools, they will be using AI tools all day, every day, whether or not they know it or not 5 years from now, because it's just going to be part of everything. The same way that mobile is now part of everything, the same way that the internet is part of all the technology that we use. So that's sort of like number one, is this is actually just going to be adopted by everybody, even if they don't realize it, right? We've all adopted AI all the time. You mentioned Google, Mark. I mean, every result that you get back from Google is in some way processed using AI, right? So that's the first thing. The second thing is there will be new types of software, new types of capabilities that were not possible before, like Jump, that are now possible, that maybe take a little bit more of a proactive look, like, hey, I'm actually going to add something to my tech stack that's a new thing. And I think those are the areas where those that move quickly and learn how to use those tools will be at an advantage in the near term. And then finally, I mentioned this in Nashville when I met Mark, but there are going to be so many more ways for bad guys to cheat and defraud clients than before. And I'll just give you a couple examples. What is generative AI good at? Well, it can summarize information. It can compose text. It can write things. There are other tools that can imitate your voice, even just with a few seconds of a sample. In fact, you guys could go and get onto like 11 Labs and put in a voice sample of Ray and a voice sample of Mark and have it generate a whole episode.
And it'll defeat voice recognition software.
Wow,
that's
impressive.
Right. And so, just imagine, I had a cousin 10 years ago that got like this fake IRS, like, hey, you owe us a bunch of taxes and the police are on their way and you better wire money or else, you're going to be in jail. And they fell for that and lost most of their life savings at the time. Imagine how much more convincing those kinds of ploys could be.
Yeah, that stuff's already happening.
Yeah.
That's already happening. You're right. This is it's the bad guys are the earliest adopters of AI, and in fact, most of their attacks are now fully automated using that. Yeah.
Yeah. So we'll just see that a lot more, and so being proactive to protect, not just help our clients invest, but help them protect what they have from this is going to be super important.
Hey, Parker, if people want to know more about Jump, where should they go?
Yeah, so our website is jumpapp.com, JUMPAPP.com. And of course, we've got ways to do a demo or do a trial or, learn more.
Okay, that's great. So I know we're bumping up on time. We try to keep these episodes pretty tight and short. Parker, thanks so much for bringing clarity to what seems like a big chaos in the AI and wealth management. Appreciate you being here today.
And congratulations. You guys have built a great company.
Yeah, thank you so much for having me. Have a good rest of the show, guys.
You got it. Well, that's a wrap on this episode of Contrasting Viewpoints. If you're an advisor still clinging to manual tasks and legacy systems, maybe today's a pretty good wake-up call. Like AI isn't coming. As Parker said, it's already here. The only question is whether you'll partner with it or get left behind by it. Mark, as always, it's always great to be with you.
Great. It's always enjoy it every time.
Before we go, don't forget to rate today's podcast. Give us a 5-star if you liked it. And thanks for joining us today for this episode. And we'll see you next time.